Hello everyone and welcome to today's class. In today's class, we will be looking at the introduction to our course, that is BBM 122, and the title of the course is Principles of Accounting 2. In today's class, I want us to look at the course outline and look at what is expected of us for the entire the title of the course is Principles of Accounting 2, and the code is BBM 122. And for those who are taking financial economics, your code should be ECF 120. This is a continuation of the Principles of Accounting 1, which was taught in the previous semester. So there are a number of sections in this course outline, where we have the first section comprising of the title and the code of the course, the second section comprising of the purposes and the objectives of the course, then the third section comprises of the course content, what we will use to achieve our objectives, and of course the final section of the course outline looks at the assessment, course delivery, and the recommended course texts. So we will look at each section so that we get to know what is expected of us. If you can look at your screens, you have the course purpose, and as you can see, the purpose of the course is to enable the learner acquire knowledge, skills, and attitudes in various areas in accounting. The first area being accounting for non-profit making organizations. How do we then prepare accounts of these organizations whose main aim is not to make profits? The second area of concern is accounting for partnership firms. In other words, we will look at how do we prepare financial statements of that form of business organization we call partnership. And lastly, we will broadly look at company accounts and limit ourselves or focus on the area of issue of shares and ventures. So that means we will not entirely cover the topic of company accounts, because as we progress, we will be covering the rest of the part in our next academic year. So we will look at that section on issue of shares and debentures. And then our next area, under still the course purpose, is the course objectives. So what is then the objective of the course? As we have looked at the introduction or the purpose of the course is to look at the three main areas. Then our objectives have been broken down into the three main areas. And of course, we are saying then that the objectives of the course is to enable learning about, number one, the preparation of financial statements of non-profit making organizations. So in this case, we want to achieve that objective of preparing financial statements of this other form of organization, that is the non-profit making organization. And we'll be able to see the various types of non-profit making organizations and even look at how do they compare with the accounts of profit-making organizations. Number two learning objective is to enable learning about the preparation of financial statements of partnership firms. As another form of business organization, we have the partnerships. So our aim is to achieve that objective of preparing financial statements of these kind of organizations. And thirdly, we will look at preparation of accounts of issue of shares and debentures. Issue of shares and debentures. And when we talk about issue of shares, there will be other areas of concern that we will look at that includes forfeiture of shares. And when we talk about forfeiture, we are talking about the cancellation of already issued shares. That then means that learning objectives, the expected learning objectives, will be mirroring from the course objectives. So, what are the expected learning outcomes? That is why you are told that by the end of the course, you should be able to, number one, prepare financial statements of non-profit making organizations. Of course, previously we have been preparing financial statements of profit making organizations. But at this point, we will be looking at those accounts of non-profit making organizations. So as an expected learning outcome, one should be able to prepare these financial statements of non-profit making organizations. Learning objective number two is you should be able to prepare financial statements of partnership firms. And when, of course, we talk about the partnership firms, we are talking about that business that has more than one owner. And the owners, in this case, we call them the partners. So how then do you prepare the financial statements of this kind of firms? And thirdly, learning objective number three is your ability to prepare accounts of issue of shares and forfeiture of shares. Of course, after you then do the cancellation of shares, sometimes the management of an organization may decide to reissue such shares afresh. And therefore, how then do you go about preparing the accounts for the same? So those are our expected learning outcomes, and you can see they are the mirror of the course objectives. But for us to achieve these objectives, we have the course content. And our course content has been prepared or divided into the broad areas, into three broad areas, and each area will touch on a particular objective and hence a particular learning outcome. So we have categorized our course content into three. The first one being the company accounts, and in this case we are saying it is an introduction, and in essence we are then saying it is an issue of shares. So we are being introduced to company accounts, but the introduction will focus on the issue of shares and debentures. Therefore, we have quite a number of areas in the company accounts that we will cover, among them being the shares and share capital. So we will get to know what is a share and what is the difference between a share and share capital. As you will learn later, is that a share will be a unit of ownership in a company. A unit of ownership in a company. So this unit of ownership in a company is normally valued. It's normally valued. So we will be having what we call the value per share. So assuming that you have 100 units of shares and each unit is 100 shillings, then that tells you that the 100 shares will be equal to a value of 100 shares multiplied by the value of each share, which is 100 shillings. That will give you 10,000. So that means your share capital then becomes 10,000 shillings. So that 10,000 shillings arises from owning 100 units of shares whose value is 100 shillings each. Then number two, we will look at the types of shares. And in this case, we will look at the various types of units of ownership. Let us not confuse the types of shares with the types of share capital. Those are two different things. So when we talk about the types of shares, we are talking about the rights that a shareholder has. And in this case, we basically have two types of shares. We have what we call the nominal shares, or what we normally call the common shares, or in some books, they call them the ordinary shares. So we have the ordinary shares, and number two, we have the preference shares. We have the preference shares. So when we talk about ordinary shares, we are talking about those shares that do not carry any preferential rights. It means their rights only are limited to the residual amount when it comes to what we call liquidation. So when a company liquidates or is liquidated, then the ordinary shares will wait until all the other obligations have been settled before they are given anything, if at all it remains. And they do not have any specific rate of payment of dividends. So when it comes to the payment of dividends, they again rank last because they will be the last ones to be paid dividends. So it means you have to pay all the preference dividends before you pay the ordinary dividends. And of course, when we talk about the preference shares, we are talking about those shares that have what we call preference or preferential rights. When we talk about preferential rights, it means they come first when it comes to the payment of dividends, and they also come first when it comes to the liquidation payment. So they are preferred. That means they have a particular rate of dividends, and of course they will be the preference shareholders will receive their preference dividends before the ordinary shareholders receive their dividends. The third area that we will be looking at is now the issue of shares. In this case, we will look at the various methods that we have of issue of shares. So we have several methods of issue of shares. Sometimes we may issue them through a bonus issue. Sometimes we may issue them through a script issue. Sometimes we may issue them through a prospectus. Sometimes we may issue them through placing and etc. So we will look at the various methods of issuing shares. And we will then look at how do we maintain the records of issue of shares. And after we look at those various methods and the accounting treatment of issue of shares, sometimes when a company issues shares, they may require that the payment for such shares be done in installments. So if that is going to be the case, then how are we going to maintain the accounts of issue of shares in installments? So in the issue of shares in installments, it will depend on the policy of the company. How many installments will there be for the issue of shares, and even the value of each share that is being issued. So in that case, then we have various installments through which shares will be issued and the amounts collected. So there will be monies that will be received when the application for those shares is made. There will be monies that will be received when those shares that have been applied for are allocated to the applicants. So we call that allotment of shares. So how then do we maintain the accounts of issue of shares on application and issue of shares on allotment? And then after that, there could be other installments which we call calls. So the company may then, after allocating shares to the applicants, require the remainder of the monies unpaid to be paid. So they will make calls to the applicants who have been allotted the shares. And how then do we maintain the accounts of the calls that have been made to the allottees of these shares? And at some point, we will also be looking at how do we issue shares at a price which is more than the value of that share. So if a share, for instance, has been valued at 100 shillings, sometimes because of maybe the reputation of the company that is issuing shares, and of course the goodwill, it may decide to issue those shares not at 100 shillings, but at a price more than 100 shillings, let's say 120. So then it means those shares have been issued not at the face value, because the face value, or what we call the nominal value, is 100 shillings. They will have been issued at what we call a premium. So the 20 shillings up and above the 100 shillings face value is what we call a premium. So should that be the case, when you are issuing shares at a price more than the face value, we say that the shares have been issued at a premium, and therefore, how do you record the premium, that is the 20 shillings on top of the 100, and how do you record the 100? And at some point also, it is possible that you can issue shares at a price less than the face value. You can issue shares at a price less than the face value, meaning if the face value is 100, you can issue the shares at a price less than 100, let's say 90 shillings. But the Companies Act does not, the Companies Act of 2015 does not permit the issue of shares at a discount, because that will amount to the reduction of the share capital. That will amount to a reduction in the share capital. However, we are saying it is possible that shares can be issued at a price less than the face value. And of course, the question will be, when can we be permitted to issue shares at a price less than the par value, given that the Companies Act prohibits the issue of shares at a discount? Now, when shares have been issued and calls have been made, the defaulters on the calls, the defaulters on the calls will have their shares being cancelled. And once the shares have been cancelled, the monies received will not be refunded. So if a call has been made to repay the installment on calls, and some of the applicants or the allottees fail to pay for those shares, then those shares are cancelled, meaning they are forfeited. That is what we call now forfeiture of shares. So the forfeited shares can be issued again under what we call reissue of shares. Under a reissue of shares. It is these shares which are being reissued that can be issued at a discount. So it is the forfeited shares that can be reissued at a discount. So at this level, you are free to issue shares at a price less than the par value. But remember, these are shares that have been previously issued and thereafter cancelled. So meaning some monies must have been received from the previous issue. So in essence, you will find that if you total the amount that the shares are being reissued at plus what was received before the cancellation, then the amount should either be equal to the par value or more. So we are therefore saying that shares can only be issued at a discount if they are being issued for the second time, having been cancelled the first time. Now, having said that, then we have what we call redemption of shares. Redemption of shares. When we talk about redemption of shares, we are talking about buying back previously issued shares. So there are those types of preference shares, and remember it's only preference shares of a particular type that can be bought back by the company. So when we talk about redemption of shares, we are saying the company may decide to purchase back some of the earlier issued shares, and only preference shares can be bought back, and of course a particular class, and that class of shares will have what we call a maturity period. So that maturity period, when it lapses, then the company will buy back those shares that it had issued. So how then do you maintain the accounts of shares that have been purchased back? And lastly, on the first topic is the rights issue, bonus issue, issue. When we talk about a rights issue, we are talking about a right that is given to the existing shareholders to purchase additional shares. And when they are given this right to purchase additional shares, they will do so in proportion to what they already own in the company. For instance, you may be told that you are allowed to add 2 shares for every 10 that you have. So that means the proportion of ownership will not change. But this right being given to the existing shareholders does not become an obligation, meaning it is not a must. It is not a must that the existing shareholders buy the additional shares. Yes, they're given the right, but they are not forced to purchase the shares, the additional shares. So it is voluntary to purchase additional shares. However, they are given that right or priority to buy them. And when they are given this, they are going to buy them at a price that is lower than the market price. When we talk about a bonus issue, we are talking about issuing shares uh, by way of capitalizing profits. So, in other words, we are saying in a bonus issue, instead of the shareholders receiving dividends, they are given additional shares. And even the additional shares that they will be given will be dependent on the proportion of ownership. So instead of receiving dividends, you opt to receive additional shares. So you increase your capital in the company. And then a script issue is the same as a bonus issue. A script issue is the same as a bonus issue in the sense that instead of the owners will be given additional shares. However, the difference then comes in between a bonus issue and a script issue is that you have a choice. So in a script issue, you don't have a choice. You will only receive the additional shares instead of dividends. But in a bonus issue, you have a choice. You can decide to receive additional shares or you can decide to receive your cash dividends. Then our topic number 2 is accounts of non-profit making organizations. Accounts of non-profit making organizations. And when we talk about non-profit making organizations, we are talking about those organizations whose main aim is to serve the interest of the members, is to serve the interest of the members. So if then it is to serve the interest of the members, you do not declare any profit because they do not exist to make profit. So their main objective is not profit making, but rather to serve the interest of the members. So even these organizations prepare final accounts. So which are then these final accounts that they prepare? And what is the difference between the normal final accounts of profit making organization and a non-profit making organization? So normally, if these organizations are meant to serve the interest of the owners, then we have what we call subscription accounts. Because this, if you have to become a member, you have to pay subscription. And normally, subscription can either be annually, monthly, or even whichever way the organization may decide. So we have, when you join, we have the membership fee, and then we have annual subscriptions. So how then do you maintain the accounts of the annual subscriptions? That is why we have subscriptions account. Then an equivalent of a cash book, an equivalent cash book in a profit-making organization is what we call a receipts and payments account. A receipt and payments account. So in a non-profit making organization, the form of cash book that they have is what they call a receipts and payments account. So this then will be able to record receipts of cash and payments of cash. So it is an equivalent of the cash book. And an equivalent of the income statement, an equivalent of the income statement is what we call an income and expenditure account, an income and expenditure account. So that means that in this kind of organizations, we have what we call the income and expenditure account, which in a profit-making organization is called an income statement. And you know, the income statement is to help you determine whether you are making a profit or a loss. So in this case, then you will be looking at at the income and expenditure. And in this case, if the expenses or if the expenditure is more than the incomes, then the difference is what we call a deficit. But if the income is more than the expenditure, the difference is what we call a surplus. So a surplus is an equivalent of the net profit. A deficit is an equivalent of the net loss in a normal profit-making organization. And then we have the balance sheet. And of course, this is more or less the same because it will be showing the assets and liabilities of the entity. So the non-profit making organizations, be they churches, be they non-governmental organizations, that is NGOs, charitable organizations, membership clubs, and etc. Those ones will prepare final accounts of non-profit making organization. So that will be our topic number 2. And lastly, our topic number 3 is to look at partnership accounts. Partnership accounts. And when we talk about partnership accounts, we are talking about accounts of that organization that has more than owner, what we call partners. So partners will then, in this case, contribute capital and form this organization to make profits. So in partnership accounts, we will not entirely look at it, but we will look at the final accounts of the partnership accounts. Other aspects of the partnership, like what we call conversion of partnership into a limited company or dissolution of a partnership, will be dealt with in our subsequent courses. So in this course, we will only pay attention to the final accounts of partnership firms. And in this case, we will be looking at a number of things. Number one is when it comes to what we call admission and retirement of partners. Admission and retirement of partners. So when partners are admitted, when new partners are admitted into the partnership, then you expect certain things to be changed. Number one, you expect that the profit sharing ratio will change because you have brought in a new partner. Then it means your profit sharing ratio will decrease, meaning will change. And therefore, how do you compute the new profit sharing ratio after admitting a new partner? The same way, the profit sharing ratio will change if an existing partner retires. He can retire by doing it voluntarily or by way of death. So when an old partner retires, then it means even the profit sharing ratios will change. And in this case, it will change by increasing the ratio of the remaining partners. So how then do you compute the ratio, the change in profit sharing ratio after partner has retired? So that is what we call computation of the gaining ratio, because the remaining partners will have the ratio of profits increasing. So they will gain in the ratio of profit sharing. And then, of course, when a new partner is admitted or an old partner retires, there is the issue of goodwill that will arise. How do you deal with goodwill? Because this new partner is joining an already established business, and therefore he will have to pay something more than he's supposed to pay. So apart from contributing his share of capital, he will pay more for the goodwill. So if that is the case, how do you then treat goodwill? So this goodwill is supposed to benefit the old partners who established the partnership. So how is then goodwill to be treated in case a new partner has joined? The same way, when a partner is leaving, there will be also goodwill. So this partner who is leaving must have contributed to the formation and running of the business, and therefore, as he is exiting, there should be goodwill. Therefore, should he be entitled to a share of this goodwill? If that is the case, how is then the goodwill going to be treated? So we will do a computation or a treatment of this goodwill. And then, of course, the other issue that we will be looking at is the revaluation of assets and liabilities. When a partner is joining or leaving, then essentially it means that there will be what we call a new partnership being formed. If a partner has left, then it means the remaining partners will form a new partnership. If a new partner has joined, it means the business will become new. If it is a new business, then you need to do a revaluation. It's like you are now starting afresh. So you need to value the assets and liabilities. So there will be a revaluation of assets and liabilities. And what is more important is how then do you treat any gain or loss in the revaluation of assets and liabilities, especially to the incoming or outgoing partners. So there will be either a gain or a loss in the revaluation of assets and liabilities, and that means you should be able to know how to treat the gain or loss in the revaluation of assets and liabilities. And then, of course, we have the final accounts of partnership firms. Final accounts of partnership firms. So, how do you then prepare the final accounts of a partnership firm, and what are these accounts that you'll be preparing? And in this case, we will prepare what we call an income statement, and we will see what are the differences between a normal income statement for a, a sole proprietorship kind of business and an income statement for a partnership. So, what are the differences? Where do we draw the line between the accounts of a sole proprietorship and the accounts of a partnership firm? The other account that we'll prepare is the balance sheet. So we'll also be able to prepare the balance sheet of the partnership, and what will then be the difference between the balance sheet of a normal partnership business and the balance sheet of a sole proprietorship kind of business. We'll be able to look at the differences, and one of the differences is simply how do you treat capital in the financial in the balance sheet, because remember the capital has been contributed by the many partners forming the partnership. So we'll be able to look at the differences between the financial statements of a partnership firm and the financial statements of a sole proprietorship business. And those then forms the areas that we will cover for the course. So this course content will assist us achieve our course objectives. Then, how do we deliver the course? As you are aware, we will do a combination between face-to-face and online learning. And of course, we already said what percentage of face-to-face and what percentage of online should we have. That is 30% face-to-face and 70% online. And then assessment of the course. So we have the continuous assessment, which will be comprising of class exercises, which will comprising of sit-in tests and assignments, accounting for 30%. And of course, 70% will come from the end of semester exam, making a total of 100%. So the core texts of the course are the ones that you can see on your screen. We have this financial accounting by Heinemann Kenya, a 206 book, and we have this of financial accounting by Kimoda, uh, published by Heinemann Kenya, and then we have the advanced accountancy by Gupta, by Sultan Chandra and Sons of 1998. So those are the core texts of the course, but of course you should be able to access other learning materials that are relevant to the course content that we have just gone through. So that is the course outline for the course, and in the next few weeks we will be tackling the three broad areas as we have gone through them. That will be the end of our introduction to the course. Until our next class, I wish you the best.